Do you use a credit card and wonder if you should be paying it off in full each month? Or do you have any questions about credit cards? Hi, I'm Tracy, and if you answered yes, I got you. This video is going to be for you. I'm going to answer all those questions and many more, like how many credit cards should you have, some of the advantages of using credit cards, and what happens if you don't pay, and so much more. So let's get started. Let's jump right into that question. It's a good idea or a bad idea to pay off your credit card in full? This is an easy one. It's an excellent idea. And if you can pay your credit card off in full and still pay all your bills, such as your rent and food, then do so. And do it every month or every credit card statement. There's only one situation that I see in which you shouldn't, and we'll touch on that a little bit later. Now, rewinding a little bit, a credit card is just a financial tool that's going to allow you to borrow funds up to a predetermined limit for purchasing goods and services. And this means that they are an open line of credit. And credit cards work in a way that you get a monthly statement at the end of the billing cycle. Billing cycles can be normally 30 days, but it's a very good idea to know when your billing cycle actually is. Now, credit cards have some of the highest rates or annual percentage rate. Now, this means if you don't pay off that full balance by the due date, your interest is going to be charged to that remaining balance. For example, if you have a balance of $5,000 on your credit card, it's going to take you 33 years to pay it off if you only pay that minimum payment, which means you're paying an extra $17,000 in interest, which is 3 times that original balance, which is just crazy. So regarding that question on repayment, it's always a good idea to pay that full statement balance by the due date to avoid all interest. By doing so, you're basically freeing up more income that would have been lost to interest. Also, if you can't pay in full, then make at least a partial payment instead of making that bare minimum payment. Now, let's just chat briefly about how many credit cards you should actually have and why. So first of all, I love credit cards, but how many do you actually need? So it really depends on your lifestyle, but for me, I think it's around 1 or 2. So I have a Visa and a MasterCard because some stores can be selective. I also think it's great to have a joint credit card if you're in a relationship. I don't like having too many because there's a risk of you forgetting what you spend and missing that payment date. Now, I always pay my credit card off in full, and I use it to fully maximize any rewards it may have. Most credit cards earn rewards such as cashback points or travel miles. I have one that I use for food rewards and the other one I use for travel rewards. But also don't forget to look for additional benefits that might be included, like purchase protection, travel insurance, and any extended warranties. Let's circle back to when I said there's one time when you shouldn't pay off your credit card in full, and that is going to be when you actually have a higher loan rate than the credit card. And this usually only happens with a payday loan. So for example, if you have a payday loan with a rate of 25% and your credit card rate is only 19%, then you should really focus on the payday loan. But don't forget to factor in the amount of the loan, as if your credit card loan is bigger, then it might be smarter to pay that one off first. Remember, the key here is just to reduce the amount of interest that you are paying. So basically, if you can't afford it, then don't buy it. Now moving on, how does paying your credit card impact your credit score? Well, your credit score is basically just a numerical value of your credit worthiness, and this is going to be based on your credit history. It ranges from 300 to 850, and the highest scores indicate better worthiness. There's lots of reasons why a credit score is important, and some of them could be your loan approval, also your interest rates, and the credit limits. There's actually a lot more, but we don't need to go into detail here about those. Now, using a credit card responsibly, such as making those payments on time, keeping any balances low, is going to positively impact your credit score. And things like your late payments, high balances, and maxing out your card is going to negatively affect your credit card. So let's explain why you need a good score with an example. In this example, Sarah's credit score is 750, which is actually good. She applies for a mortgage to buy a $300,000 house. The lender checks her credit score. With a credit score of 750, Sarah is considered low risk, so the lender approves her mortgage application. Because of her high credit score, Sarah can qualify for a lower interest rate, let's say 3.5% compared to 5% for someone with a lower score. With a 3.5% interest rate, Sarah's monthly payments are going to be approximately $1,300. But if her score was lower and she received that higher interest rate, her monthly payments would actually be around $1,600. So over a 30-year mortgage, the difference in total payments is significant. Sarah is saving $94,000 in interest over the lifetime of her loan because of her credit score. Now, do you have credit card debt and you just can't pay it off in full? If yes, I'm going to recommend you watch my debt video in which I discuss the topic, but in short, you're going to want to choose a repayment strategy. Personally, I like the debt avalanche method, and this is where you're going to be focusing more on high interest debt. So you're paying the credit card with the highest interest rate while making minimum payments on those ones with the lower interest rates. I like this because it saves money on interest over time. For example, if Sarah has 3 credit cards, credit card 1, $5,000 at 18%, card 2, $2,000 at 15%, and card 3, $1,000 at 12%. She's going to start by a step-by-step plan by first creating a budget. She identifies that she can pay $500 a month per her debt repayment. Step 2, she chooses a strategy. She's going to opt for the debt avalanche method that we previously already talked about. So in this example, Sarah's going to focus on paying off credit card number 1 because it has the higher interest rate and the larger balance. While she's paying off credit card number 1, she's going to ensure that she still pays the minimum balances on credit card 2 and 3. After she pays off the credit card number 1, she's going to do the same with credit card 2. My final thoughts are credit cards are really valuable. They are a great financial tool when you use them responsibly. They can offer you convenience, that ability to build a credit, and all those various rewards and benefits that they come with. However, it's crucial that we actually manage the credit cards carefully because you really want to avoid any high interest debt and maintain that really great credit score. Thanks for watching. I'll see you in the comments below. Much love and thanks, Tracy.